Hey traders, welcome back to another video. Today we saw the New York manufacturing activity shrink more than expected. Now, of course, this is an economic study that we're going to dive into here, and we're going to see how this impacts the charts. The New York Empire State Manufacturing Index unexpectedly shrank to minus 31.8 in May from the 10.8 that we saw in April, compared to forecasts of minus 3.75. It is the lowest reading in 4 months as new orders and shipments plunged, employment fell for a fourth month, and prices increased slightly. Meanwhile, the 6-month business conditions index increased only marginally. So what did this do to the markets, and are there any setups that we should be watching here going into the day? Let's take a look. So first I figured we could take a look at the dollar, which gave back a little bit of its recent gains here this morning. And again, signs of a slowing economy are an interesting thing for the dollar because, again, as we know, the Federal Reserve is watching a couple key things. They're looking at jobs and they're looking at inflation. Now, why do I mention the Fed? Well, we'll go over that. So they're looking at inflation, they're looking at jobs. Okay, this is within the scope of the Fed. And we'll get into technicals, we'll get into technical chart setups and stuff, but I just want to focus on this for a second. If jobs suddenly suffer dramatically, meaning unemployment rises and inflation also stays very high, that is the serious concern about something called stagflation, which is where you get unemployment rising, but you also have prices rising. This is a very dangerous spot in economics. It's a very dangerous spot for an economy to be in. And so the Fed is very interested in this. And when it comes to raising rates to try and combat inflation, if they raise rates too much and it hurts the job market dramatically, that is also against their mandate, which is, again, their focus is to focus on these two things: healthy jobs and healthy inflation. So with that said, with the jobs market potentially being under pressure by some of this economic data that we're getting, and also seeing inflation stay stubbornly high, what is the take? What are we looking at? Well, I'm still not a big bull on the dollar index, but I think from a technical perspective, we have to acknowledge something. We had a key breakout here, right? Price was able to break 102.2, and in the short term, I would say this looks very strong for the US dollar. Now, does that mean I'm going to be buying the US dollar? Personally, not really. Why is that? Well, we'll go into that in just a moment in terms of bigger picture stuff. But I want to show you a chart that I am bullish on. I'm bullish on gold. And you guys who have been watching the streams and videos, you know this. You've been seeing me say this. This is nothing new. But let me give you an update on my current position. Here is my gold trade. I'm floating $147 on this particular trade and watching as this thing continues to develop. As long as it holds the 2000 mark, which is this area right here, this green zone marks sort of the upper limits of this zone of support where we saw markets break out of recently. So we've broken out, we've held this zone. As long as we stay above this, I'm going to maintain a bullish perspective on the gold market. If this thing breaks out to the downside, I will stop out and I'll take a loss on gold. Regardless, here's why I am not super bullish on the dollar and I'm more interested in gold. I've made this point a couple times, but let's list them again for simplicity. The first thing is, of course, the banking situation. So regional banks under serious pressure could cause some fear in the markets, and substantial fear as people potentially lose trust in the banking situation. It could cause a run on the gold market. This is not something new. This is something we've seen even recently with banking fears rising suddenly. So that story is potentially bullish for gold. The also situation that I've mentioned several times is the debt ceiling here in the United States. Fear around the United States debt situation could prompt a bigger move to the upside on gold. And of course, we continue to see very high levels of inflation. Even though it's on the decline year over year, it's still very high. And I want to show you this in terms of a technical perspective. I'm still long over here. I'm looking for a return back to the highs and potentially even a breakout. But I want to show you something very notable from the EdgeFinder point of view. Okay, so if we're taking a look at this, in terms of gold specifically, I'm going to pull up the commodities market. I'm going to pull up gold. I want to show you something here. Inflation is still in a bullish category for the gold market. What we do here is we give +2 in our algorithm here for the EdgeFinder. We get +2 scoring, meaning +2 on the bullish camp in areas above 4% inflation or more. If we get 4% or more inflation, the gold market gets a pump on our scoring system. Now, again, we use an algorithm that we have built here at A1 Trading to sort of derive these scorings. You can read all about that within the educational sections available for the EdgeFinder. If you have access to it, you can read through the help sections and all sorts of stuff like that. Also, guys, I do want to remind you that if you want to check out the EdgeFinder, we have a free trial link down below in the description. If you want to have a free trial to our software, here's how you can do so. If you click the link that's in the description, it's going to open up a chat prompt. It looks like this, and it's going to open up, and you can just click here, click chat now, and click EdgeFinder Trading Software Access and ask one of our support reps. This is a live chat feature. You're getting connected to a real person right away. It's not an AI, it's not a bot or anything like that. A real person will get you set up with a free trial, no credit cards, no strings attached. We'll just ask you for your email so that we can keep in contact with you. If you want to try out our software, we are a software company out of Atlanta, Georgia. We build tools for traders. We want more people to use our tools, but we want you to try it out for yourself first. We are still bullish on this category. GDP growth declined, showing economic shrinking. Another bullish reasoning for gold. Unemployment stays pretty resilient, so that's not necessarily a bullish one for gold. Interest rates also on the climb, but if this pauses or shrinks, that will be incredibly bullish for gold. And then money supply is still on the rise here. So, you know, we have some bullish camps here in terms of that. Now, also in terms of COT data, institutional money is very long gold and still maintains a bullish positioning as of the most recent COT data pulled in by our software. And then finally, retail is short. So we have so many things here that are pointing towards a very bullish gold market, which is why I'm very confident to continue holding my long trade until proven otherwise. I'll stop out if needed, but that is my positioning on gold, and we'll see if I'm right or wrong. I've been doing this for a long time. I've been wrong in the public eye many times, and as we like to say, when I'm wrong, I get the sink thrown at me. And, you know, that's being a YouTuber in this stuff. I accept that role. I'm putting myself out there. I know that I could be wrong. And if I am wrong, you know, please know it shouldn't be a surprise. Sometimes I'm right, sometimes I'm wrong. It's about how you manage your winners when you are correct. Speaking of COT data, I want to just give you guys a chance to look at this. If you guys don't have the EdgeFinder, here is the latest data in terms of COT data. We can see gold continues to be the most proportionally longed asset on this list, and the Japanese yen proportionally the most short. We also have S&P on the most proportional shorts, the Nikkei as long, euro long, platinum long, US oil long, dollar long, and you can take a look and feel free to pause. We'll also show you guys some more data here, the full chart here. So here's the latest in terms of gold. If we narrow in on gold, you can see there was an increase in long positions and an increase in short positions, with longs slightly outpacing, with the net long futures contract showing very heavy preference to the long side compared to the short contracts opened. And then if we take a look at some other assets, again, you could pause the video if you want to take a look at it. The Japanese yen, you know, saw a shrink in both areas, but still maintains a very heavy short presence. The S&P 500 notably had a very large increase in shorts. That's kind of a concerning thing for the indices. I'm not long S&P. Right now I have no preference on that. However, NASDAQ saw the inverse. Very interesting that we saw a big rise in long positions, bringing us to a 57.69% long ratio compared to a short ratio much smaller. The NASDAQ of the indices to me right now looks like the most potentially attractive. We saw a price rally off of this 13,250 level, and you know, I'll continue to watch this one for possible pullback plays or breakout plays, breakouts, continuations. I think the NASDAQ looks really ready for more upside. It's been the strong player, and part of the reason for it, if you're watching this, is you know, you've got Google flying high, you've got Meta flying high, you've got Apple, you know, killing it. These are big companies that are sort of tech-oriented companies that are dragging that NASDAQ higher, whether it likes it or not. And then you compare it to the S&P 500 for the index traders out there, right? The S&P 500 really lackluster. It's trading sideways. For the real indices traders, you also know that, of course, you've got the Russell, which is struggling here, not doing nearly as well. And that boring US 30, that Dow Jones, cannot seem to catch a bid like the NASDAQ can. So, you know, right now I continue to try and trade strength. I had a really excellent session with Ivan today where we discussed this. We discussed the idea. I asked him whether or not he would trade the NASDAQ or whether he would trade the S&P 500, and his answer was very interesting. Check that out right here. And then also, Ivan, I wanted to follow up. So we're talking NASDAQ. You said buying retests after breakouts. I'm kind of with you. My question for you though is, do you trade in this situation? Do you focus on the NASDAQ, or do you focus on the more lagging indices like the S&P, which has not been able to break the highs, right? The NASDAQ benefiting massively from a lot of tech stocks performing very well, Google, Meta, Apple, Amazon, all of them catching good, strong bids and dragging the NASDAQ higher? Or do you focus on one of the slower moving ones that are lagging behind right now, like the Dow, the US 30, which, I mean, this chart even looks somewhat bearish, right, on that 4-hour chart. So it's an interesting divergence. What do you think? Do you focus, do you continue to look at the winner, or do you look at the ones that are lagging behind?
Why not look at the winner chicken dinner?
Yeah.
Yeah, I am. I'm fully aware of that. What do you call it? S&P is somehow range bound, which is kind of somehow expected. There's also the saying, I guess, the theory about selling may and go away, which kind of hasn't happened yet. So until that happens, and I believe once the debt ceiling situation has been resolved, which in my opinion will be resolved, we're going to see a fresh rally. So it's just to get in before that kind of happens.
Yeah, no, I'm with you on that. I do think that it is a passing trade. The question is, if you had to pick one, would you trade the S&P 500? Okay, let's just put you on a position. You either have to buy and hold gold for a month, or buy and hold the S&P for 1 month. It's a call option on one or the other. It expires at the end of 1 month from now. Which one would you be looking at? And of course, not financial advice. It's just we're having fun.
NASDAQ is more volatile, so I might end up in loss. S&P is less volatile, so I guess I will do S&P 500 in case we all fall down.
Hey, guess what? I just found a video made just for you. Click this video to help with your trading, and thanks for watching.